The United States, a global superpower with the most influential economy on the planet. But now, its national debt has already reached 36 trillion US dollars, representing about 122% of its gross domestic product, GDP. Meanwhile, the labor market is showing several signs of weakness. Official reports recorded only 73,000 new jobs in July 2025, far below expectations, sparking concerns about a stall speed in the job market. Not only that, according to JP Morgan's forecast, tariffs and government spending have fueled inflation and slowed growth, pointing to the potential risk of stagflation similar to the 1970s. Has the US economy lost its stability, or are we just standing on the edge of the cliff? So, in this video, we will look at the reasons behind America's economic downturn and the risks it poses to the world. Keep watching. For decades, the United States has been at the top of the world with a GDP exceeding 30.33 trillion US dollars in the second quarter of 2025. China, in second place, recorded about 19.37 trillion US dollars, and this gap proves just how dominant the US is in the global financial system. However, 2025 began to paint a very different picture. It started in 2022 and 2023, when the Federal Reserve aggressively raised interest rates to 5.25% to 5.5%, the highest level in 22 years. This move was taken to control inflation, which peaked at 9.1% in June 2022, the highest in 40 years. At first, the impact on the people wasn't strongly felt since many homeowners and businesses had locked in loans at lower rates during the pandemic. On top of that, the boom in artificial intelligence, AI investments, created a bubble in the stock market. According to the Washington Post, tech giants' spending on AI is expected to hit 350 billion US dollars in 2025. But this injection was only temporary. By mid-2025, inflation remained high even though interest rates were at their tightest since the early 2000s. The housing sector began to slow down and manufacturing also weakened, with the US manufacturing PMI staying below 50 for several consecutive months. Even more concerning, the labor market, along the backbone of the US economy, started to show cracks. Monthly job gains slowed, and large companies outside of tech began announcing waves of mass layoffs. And in the midst of this slowdown, the president's own economic policies added more weight to an already heavy burden, forcing investors to ask, is the American dream still relevant in the 21st century? Donald Trump returned to the White House with a trade agenda even more aggressive than in his first term. This time, his administration raised and expanded tariffs, including against India, which hurt regional market sentiment and forced New Delhi to reassess its defense ties with the US. The market impact was clear as Indian equities went through their longest weekly losing streak in 5 years, with investors waiting for clarity on US tariff direction. From a macro perspective, JP Morgan analysts warned that higher tariffs and new government spending could trigger a stagflationary slowdown. Weak growth combined with stubbornly high inflation. To understand how tariffs work, the 2018 experience is an important reference. An NBER study found that almost all the tariff burden was actually borne by US consumers and importers. At the peak of the trade war, Americans' real income fell by about 1.4 billion US dollars per month, while they had to shoulder an additional tax cost of around 3 billion US dollars monthly. Simply put, tariffs act like a silent tax, raising the price of inputs and consumer goods, keeping inflation higher than it otherwise would be. At the same time, government deficits and interest costs stayed high. In the business sector, order and output indicators also weakened. And if the cost of living keeps rising while the economy stagnates, the job market and household budgets will be on the front line of the impact. The question is, how long can they hold on? The US labor market has long been the main pillar of its economy, with low unemployment often cited as proof of the country's strong fundamentals. But in July 2025, official data from the Labor Department showed only 73,000 new jobs created, far below analysts' expectations of around 175,000 to 200,000. The unemployment rate also rose to 4.3%, the highest since late 2021. This decline comes in the context of slowing job growth since the start of the year. It is a clear signal that labor demand is beginning to weaken. Among the hardest hit sectors were manufacturing, construction, and retail. Data showed the manufacturing sector lost around 8,000 jobs in July 2025, while construction added only 2,000 jobs, a very low figure for a sector that typically grows strongly during the summer. Retail, meanwhile, lost 5,000 jobs, reflecting increasingly cautious consumer spending. In addition, there were signs that the voluntary quit rate was falling, usually an early indicator of declining worker confidence. When fewer workers leave their jobs voluntarily, it means they are more likely to hold on to existing jobs out of fear it will be difficult to find new ones. This problem is worsened by the rising cost of living. Although average hourly wages increased by 3.8% compared to the previous year, inflation remained at around 3.2%, leaving real wage growth close to zero. In other words, people's purchasing power barely changed, even though their nominal wages went up. This is not just a statistic. In reality, it means household incomes struggle to cover the costs of housing, healthcare, and education. On top of that, U.S. credit card debt hit $1.14 trillion in the second quarter of 2025. Many families now live paycheck to paycheck, without adequate emergency savings. Taken together, all of this is an early warning that the labor market is cracking from within. If this trend continues, it could trigger a downward spiral. And here lies the biggest risk. If people start cutting back on spending on a large scale, the entire U.S. economic engine could stall. Which brings us to the question, is their financial system strong enough to withstand the pressure? The U.S. federal government's debt now stands at around $36 trillion, with about a quarter of it held by foreign investors. The rest is owned by domestic investors such as pension funds, investment funds, banks, government agencies, and the Federal Reserve. This is important because when interest rates rise, most of the debt burden circulates domestically. But if foreign investors lose confidence, the effects can quickly spread across global markets. Among foreign investors, Japan is the largest holder with around $1.135 trillion, while China has cut its holdings to the lowest level since 2009, down to USD 756 billion as of May 2025. This shows that foreign investors are not acting the same way. Some are increasing their holdings while others are reducing them, making U.S. bond yields highly sensitive to shifts in capital flows. Over the past 50 years, foreign holdings of U.S. debt have risen from about 5% in the 1970s to around 30% by the end of 2024. This means that foreign confidence in the dollar and U.S. bonds is now far more important than it used to be. The cost of servicing this debt has also surged. By mid-2025, the U.S. was paying about $921 billion annually in interest, roughly 17% of all government spending. If interest rates remain high, more of the budget will go toward interest payments, leaving less room for other spending. The real danger is this. Although the U.S. can still manage its debt as long as the economy grows and tax revenues are sufficient, the combination of huge deficits, high interest rates, and reliance on foreign investors makes the system fragile. If interest costs keep rising while the economy slows, the dollar, the symbol of American power, will be put to the test. Will the world still want to hold as many US dollars as it does today? Throughout 2025, the dollar's value swung sharply, often pressured whenever weak job data led markets to expect rate cuts. By the fourth quarter of 2024, 57.8% of the world's official central bank reserves were still held in US dollars. Although its share has declined compared to a decade ago, it remains the most dominant currency. Data from SWIFT and other analyses show the dollar is used in about 50% of international payments, and if transactions within the Eurozone are included, the share rises to around 60%. The euro holds second place with roughly 19%. While China's yuan accounts for only 2.9% to 4.3% of global payments in the first half of 2025. Even though BRICS countries are actively promoting trade in local currencies and building their own financial messaging systems, they are still far from replacing SWIFT in the near future. However, there is a weak spot. In the first quarter of 2025, the U.S. current account deficit rose to its highest level in nearly 2 decades, reminiscent of the period before the 2008 financial crisis. A persistent deficit shows that the U.S. is becoming more dependent on foreign borrowing, and this could become a serious problem if investors lose confidence in the dollar. If the dollar remains dominant but is easily shaken by weak data or policy changes, the big question arises: what would happen to global markets if the U.S. truly falls into a recession? Even so, the United States is still the world's #1 economic power. But the cracks are becoming harder to ignore. With debt at record highs, soaring interest costs, a slowing labor market, and a dollar that is starting to look vulnerable in the eyes of the world. If all these factors combine, they could form the perfect storm that puts the entire global financial system to the test.